All right, thanks for checking out this video. I wanted to give you a comparison on the all-in-one loan using someone with a upper income bracket. And what I wanted to really do to showcase the power of this is compare it to an existing loan. We're using a primary residence. Estimated home value is 1.25 million and a loan balance of 750,000 currently. And I'm going to use a 30-year fixed. But instead of taking this and comparing it to a new loan at today's rates, which are actually above 7%, we're going to assume that you took this out 2 years ago, 24 months, and the interest rate you have is currently 3.75. That's going to give you currently monthly P&I payment of $36.08. We're going to assume income of $225,000 for your household income after taxes. That works out to $93.75 on a semi-monthly basis. If you take 3 months of income as savings for emergency fund, that would be $56,250. That can be applied against the account. You can also have your property taxes, insurance, any quarterly tax withholdings, etc. Funds that you're saving for different things can be setting in this account, offsetting your mortgage balance and reducing your interest for the life of the loan. Okay, so again, we're using $225,000 as annual household income, which amounts to average monthly deposits of $18,750. The comparison loan payment that we're using is $36.08. So remember, on the all-in-one, we don't change anything from what you're currently paying. So what you'd currently be paying on that 30-year fixed mortgage at 3.75, that's what you're going to continue to pay into this account. Your estimated taxes and insurance, this is at $1,568 a month. That may be a little bit high depending on the area that you're located. And we're using average monthly expenses above and beyond the mortgage, tax, and insurance of $88.85. So taking those all together, you have monthly expenses of just over $14,000 a month on that $18,750 income. We're assuming that you have 25% left over then after that, which would be $46.87. When we calculate the results, that 28-year remaining mortgage at 3.75, if you took an all-in-one loan at today's rates, you would still have it paid off in 9.5 years. 114 payments, you'd save over $220,000 in interest expense. Now, the rate assumptions that I'm using on this is that we're using the index. We use the CMT one-year index, which is currently at 5.37. You can see where that is historically. This is a 30-year graph on the CMT. It's currently at the highs that it's been at for the past 30 years. We're assuming in this scenario that that index plus the margin gives you an initial rate of 9.12%. And let's look at the rate assumptions that we're using here. We're using the historical average on the CMT rate. This is the constant maturity treasury, the CMT rate, and this is a 30-year historical chart on that. And as you can see, that light blue line there is where it's been for the past 30 years. We're currently basically right near the highs. So what we used on this, to be fair, is the historical average of where that rate will run at. Again, the loan that we're using for comparison is at 3.75, while today's rates are well above 7%. And even still at that, you have that savings of $221,000. But let's make it a little bit more interesting here. Instead of going at the historical average, let's say we start out at that 9.12%, and let's say we stay there forever and we never come back down on interest rates, which would be ridiculous to believe. But let's just assume that for a second, you would still pay it off in 11.3 years. You would still save over $42,000. Again, that's keeping rates at this level for the next 11 plus years at 9.1 plus percent, and comparing that to your existing 30-year fix that you've already paid 2 years down on and keeping that rate at 3.75. Pretty powerful on this. And if you have any questions, please give me a call. Thanks for taking the time to check this out.